Hello, everyone, and thank you for joining us today for the second OIC webinar in March, where it's Greeks month. As I said, this is the second webinar this month. Both cover the topics of the Greeks. Last week on the 8th, we covered the Greeks 1, which was an overview of delta, gamma, and theta. And today, I'll be presenting the second iteration entitled, you guessed it, the Greeks 2, covering Vega, rho, and some of the second order Greeks. If you were with us last week and you're back, you'll notice we're continuing the subject matter with a little more focus on implied volatility and Vega today. But the combination of these two presentations should really help to build your base of knowledge surrounding some of the conceptual pieces of options risk that we affectionately call the Greeks. So if you're here today for the first one, and you haven't watched the one on the 8th, make sure you go to the website, optionseducation.org, and check out the first webinar from March, the Greeks 1, which covers, like I said, delta, gamma, and theta. Now, we always cover a little bit of a disclaimer before we start. Options involve risk. They're not suitable for everyone. Any strategies that I discuss, including examples using actual securities, price data, they are strictly for illustrative and educational purposes, should not be construed as an endorsement, recommendation, or solicitation to buy or sell securities. Past performance is not a guarantee of future results. One other bit of housekeeping, the following trademarks that you see on the page here and service marks are owned by the Options Clearing Corporation, and you will see them used throughout the presentation today. A little bit of background on myself. My name is Matt Cashman. I am the Principal of Investor Education at OCC, as well as an Options Industry Council instructor. I started trading around 1998. I've been an options trader ever since. I got my start in Chicago on the floor of the CBOE, trading equity and index options. Quickly after that, I moved to London. I started trading interest rate options there, and I spent about 3 years there, eventually moved back stateside where I started and ran an index options market making operation for the better part of about a decade in Chicago, again on the floor of the CBOE. Currently, I work at the OCC, helping individuals and investors to better understand both risks and benefits of exchange-traded options through efforts like the webinar that you're watching today. We've already covered the disclaimer, so let's talk a little bit about OIC. OIC is the Options Industry Council. We are the educational arm of our parent company, the Options Clearing Corporation, or OCC. OCC is the largest clearing corporation of equity and exchange-traded options in the world. OIC, the Options Industry Council, started as a collective in 1992 to better educate the public as to the risks and benefits of exchange-traded options. Currently, we continue to pursue that goal mainly through the utilization of our website, optionseducation.org, which you can see right here. If you've never been to that website, I really can't recommend it enough. It is where all of our educational content is stored, a whole host of educational content covering the gamut from an incredible number of topics as far as options are concerned. You can find courses, podcasts, videos, and webinars there like the one that you are watching today. We are able to provide these services free of charge to the public because we are fully funded by our parent company, the OCC. Now, I work on a fantastic team at OIC. We are known as the Investor Services Desk or the Investor Education Desk. I sit on that desk with 3 other fantastic colleagues, 2 of which are answering your questions today via the chat during our presentation. Make sure to say hello to both Ken and Roma when you ask questions, and be patient, please, as oftentimes a lot of questions will come in at the same time. They're going to do their best to get you an answer as the webinar is happening. If you do not get an answer to your question today, you can always send us email questions related to options at this email address right here. Make sure you write it down, options@theocc.org. rebroadcast.com. This, again, is a free service that we extend to the public as well. It is important to note that we are not registered investment advisors, so we can't direct you on trades or suggest investment strategies. But what we can do and what we love to do is we love to help with general questions about options, optionality, and theoretical knowledge surrounding the options ecosystem. Amongst the four of us that sit on this investor education desk at the OIC, we have over 100 years of combined industry experience surrounding options. We are always happy to put all of those experiences to use in whatever way we can to further advance your understanding of options and how to responsibly use them in your investing on a day-to-day basis. So make sure that you send us email questions at options@theocc.com, and make sure that you check out optionseducation.org. With that said, let's jump right in. This is annual options volume from 2000 to 2022. Now you will see, obviously, a trend here over the last 20 years or so. Options volume has absolutely exploded. If you look back and give yourself a little bit of historical reference, 2008, I remember I was standing in an index options pit on the floor of the CBOE. And I remember seeing somewhere close to 4 billion contracts hit the tape at the end of the year. I also remember thinking that that was probably the most volume that I would ever see, because 2008 was probably the craziest trading environment I had ever seen up until that point in my trading career. I was wrong, and 2011 came along 3 short years later, and the advent of the sovereign debt crisis across the globe set another volume milestone, followed by a brief period of stagnation as far as volume is concerned. And then 2018 hit, where OCC cleared a record 5.2 billion contracts of exchange traded options. But we have never before seen what we've seen happen from 2020 to 2022. And we are continuing to see it in 2023. And what that is basically, from those 3 years, a doubling of options volume, more or less. Now, what that means is that last year in 2022, OCC cleared 10.3 billion contracts of exchange traded volume. This is an incredible number. It's an amazing feat, to be honest, that those kinds of numbers can happen. That means that when you think about it on a daily basis, OCC is clearing 40 million contracts on average on a daily basis. Now, when I look at this, I think about, from an educator's seat, I want to make sure that what we're doing is that much more vital to the actual marketplace, to make sure that all of these people that are in here trading and trading all of this volume really understand what they're doing with that volume. It's important to understand how options work before you walk into an options marketplace, because options, like we said, are leveraged instruments. They're not for everyone, and they can be complicated investment strategies. So let's make sure we understand how they work before we trade them. With that said, let's move on to what we're going to talk about today. We're going to cover a brief overview of some of the Greeks. We're going to cover 2 of the first order Greeks that we didn't cover last week. First one's going to be Vega. The second one's going to be Rho. And then we're going to get to some second order Greeks. Hopefully we'll have some time for Q&A at the end. I'm not sure, but the interesting part about this is that when we're talking about Vega, we're also going to weave into the discussion a really in-depth conversation about implied volatility, historical volatility, how those concepts relate to the concept of Vega, to the Greek Vega, and how you can think about those things all kind of wrapped up into one dynamic bow that we use on a daily basis. Let's talk first and foremost about these selected first order Greeks, Vega and Rho. You'll see the letters or the symbols that people generally use to refer to these 2 Greeks. The first one is Vega. Vega is the expected change in your option value with respect to changing implied volatility levels. So now you can understand why we're going to weave in to the conversation the concept of implied volatility, because Vega is directly related to implied volatility. Vega tells you how much your option should move when you move implied volatility around. That's basically how much theoretically your option should be moving when you move vol by 1% up or down. The second Greek that we're going to talk about is rho. It is the expected change in options value with respect to a changing risk-free interest rate. Again, it's how much your option should theoretically move in value terms when you move around the risk-free interest rate. Rho is one of those things that for the last probably decade or so, a lot of people didn't really talk about it. And why is that? Well, the reason why is because we have been in a zero interest rate policy environment for the better part of about 15 years. And so interest rates haven't really moved that much. Well, rho is something that people are really starting to pay a lot more attention to, because when interest rates are 4% or 5% or 6%, they have a lot more room to move around. Ask any interest rate options trader whether they'd prefer to trade options in a 6% market or a 0.25% market. And they're going to tell you the 6% market is a better place to trade because things move around a lot more as far as the interest rates are concerned. When interest rates move, options are going to move by their rho. So you need to make sure you understand how that works, because we're moving into an environment where options are going to be, or part of their valuation is going to be involved in how much rho they have. So let's make sure we cover that as well. Now, we're also going to cover a couple of the second order Greeks. These are less talked about, but very important, especially once you start to think about options as how you can carry multiple different options in one large portfolio. Options Greeks, the second order Greeks, are really something that market makers use a lot of time because they actually have these large portfolios that have lots of different moving parts to them. And second order Greeks can help you to think about how your position's going to move when the other Greeks move. Here's a little introduction to the second order Greeks that we're going to talk about today. Second order Greeks are additional Greeks. That's exactly what they are, right? They're the second order, meaning they are derived from the first order Greeks. They're ways to measure change of those first order Greeks relative to movement in other Greeks or exogenous factors like time. Second order Greeks that we're going to cover today, one is charm, and the second one is vama. I love saying vama. Charm is the expected change in an option's delta with respect to the passage of time. Many people call it delta decay. That's what I called it when I traded. That's what I still call it. I call it delta decay or D delta V. Vama is your expected change in an option's Vega with respect to the changing implied volatility levels, also referred to as Vega convexity. The reason it's called Vega convexity is because it has curvature to it. Just like any convexity, if you've ever traded bonds before, you understand what convexity means. Convexity is the curvature of how things work. It tells you, generally speaking, how much delta you would need to buy as things would go up or as things would go down if you were short convexity. This is Vega convexity. It's going to tell you how much the Vega of an option is different if you raise or lower the implied volatility levels. So those are the second order Greeks that we're going to talk about today. First and foremost, let's talk about the nature of the Greeks in general. This applies to every single Greek on the board. Option Greeks are only meaningful during an option's lifetime. We get lots of questions about this on the investor education desk. People asking, what happens to my option Greeks? Does my delta still exist after these calls expire? The answer to that is, if you don't have options on your sheets, you don't have Greeks. option Greeks are only meaningful during an option's lifetime. At expiration, if your options are coming off, the Greeks that are associated with them are also coming off. The second thing, Greeks can affect each other. Changes in options theta, which we talked about last week, which is time decay, can affect an option's delta. And conversely, the delta of an option can affect its theta through its valuation. Many times they are not necessarily causation for the other one moving, but they do and are interrelated to each other. The impact of changes in Greeks can be different for each option contract. So if an option is in the money versus an at the money or an out of the money option, they have different levels of different Greeks associated with them. And thus, those Greeks can change in different ways when the other Greeks change. It's important that you understand how the options are related as far as their Greeks are concerned, how the Greeks for each set of options are related, and how they are interrelated when they're moving around. One other thing that can affect how much different Greeks an option can have is their duration, near-term options versus long-term options. What does the option that has 3 days left in it look like from a Greek perspective relative to an option that has 30 days in it, or 90 days in it, or a year in it? The duration of the option has a huge effect on the Greeks of those options. So it's important to think about those things as well. Big ideas here you need to remember. Option Greeks are only meaningful when the actual option exists. They can affect each other. And the differences of how these Greeks affect each other can be different for different kinds of options, in the money versus at the money versus out of the money, and near-term versus long-term options. Let's take a look at the first one we're going to talk about, Vega and implied volatility. Vega is that first order Greek that we're going to talk about first. Technically, Vega is an option value's sensitivity to volatility. It's going to tell you how much your option should change in value with a 1% change in implied volatility. Now, this is based on the inputs that you have in your model. So theoretically, if your option model is spitting out a decimal of 0.08 for a Vega for an option, it's going to tell you that that option should move theoretically 8 cents for every 1% change in implied volatility. Now that is keeping all other factors remaining constant. But what this does, this decimal expression of Vega, is it gives you a pretty good idea of how much your theoretical model should tell you how much this option should move when you're moving implied vol up and down 1%. Calls and puts both have positive Vega amounts. Now, this is something that people don't necessarily understand all the time. They have positive Vega amounts, much like they have theoretically positively expressed gamma amounts, just like we talked about last week. Gamma is an options kind of embedded potential to change, and an embedded potential to change is expressed as a positive number. Vega is very similar to that. It is expressed as a decimal form, and it's expressed as a positive number, and calls and puts both have positive Vega amounts. Now, if calls and puts exist on the same strike, the 50 call and the 50 put are going to have the same Vega amount. It's interesting when you think about it, when people ask questions about how then, if they have positive Vega amounts, do you get negative Vega positions? I hear people talk about negative Vega positions all the time. How is that possible if both calls and puts have positive Vega amounts? Much like gamma, and I said this last week, much like gamma, it is what you do with the option itself that creates either a short or a long Vega position. If all you do is sell options, guess what? You're going to be short Vega. Now, the amount of Vega you're short is going to depend on the duration of the options you're selling, but you're going to be short Vega. if all you do is sell options. And conversely, if all you do is buy options, then you're going to be long Vega. Again, duration of those options will speak to how much Vega you are long. But in that situation, if all you do is buy options, you're going to be long Vega, and your position is going to P&L as such. If vol goes down, if implied vol goes down, you are generally speaking going to lose money in that situation because of the Vega that you're carrying on your sheets. Again, the longer the duration of the option, the more Vega it will have. The shorter the duration of the option, the less Vega it will have. If you take the same option, a 50 call, let's say, that's struck at 50, and you add duration to it, you add days to expiration to it, that option is going to have more Vega than an option that has less duration to it. Now, implied vol moving up in this situation, if you keep everything else constant, is going to make option values move up by their Vega amounts. And conversely, implied vol coming down is going to make option values move down by their Vega amounts. Again, if you keep everything else constant. Now, this concept of Vega really sets the stage for the next conversation we're going to have, which is about the differences in implied and historical volatility. Let's take a look at the two types of volatility that we generally talk about when we talk about options metrics surrounding the conversation around Vega. Those are historical volatility, and then we'll talk about the big one, which is implied volatility. We're also going to sneak in a couple of theoretical discussions about price distributions as well, because they can be instructive when you're talking about how implied volatility works. So let's talk first about historical volatility. There's two main types of volatility. The first is historical volatility, which you see here. Historical volatility is what has happened in the past. It is black and white. You can measure it. You can quantify it. It is essentially how much over the last X number of days has this underlying moved. It's historical. I sometimes refer to it as delivered volatility. I get a lot of flack on the desk for calling it delivered volatility. It's a leftover from where I used to work, but I call it delivered volatility because in my mind, it's what the stock delivered, basically. But for my purposes, as far as the presentation is concerned, historical and delivered volatility are used interchangeably. Again, it's a statistic, it's a fact. It is backward looking. Backward looking. We're starting today and we're looking back. This is the historical piece of the volatility. This, going forward, is implied volatility, or a future consensus for how much people think that the underlying might continue to move going forward. This is something completely different from historical volatility, but it's really important when you're talking about how much options are worth, because it's one of the biggest things that you can build into an options valuation is its implied volatility levels. We'll talk about that in just a moment. But let's look at what price distributions look like when you have different levels of historical or delivered volatility. This is three different levels of historical vol, three different price distributions, if you will. The first one is a stock that's moving on a 15 historical vol. It's this gray price distribution that you see here. We're talking about a stock that has a $100 mean. And what you'll notice when you look at the price distribution of a relatively low historical volatility, this is a stock that's not moving that much, is that the actual amplitude of this curve is pretty high. And it's also pretty narrow. And the reason why is because each price iteration of a low delivered volatility stock is going to be clustered close to the mean. When you have low volatility environments, this is the price distribution of a stock that's trading 99.5 99.75, 100 and a quarter, 100 and a half, back to 100, 99 half. All of those price iterations are going to be clustered around the mean, which makes the actual amplitude of the distribution really steep. Stock B has a 25 historical vol. You'll notice that stock B is starting to look a little flatter as far as its price distribution is concerned. That's because it has more breadth as far as how far away from the mean these price distributions and these price iterations on a daily basis are happening. Each day, you're going to get a little bit farther potentially away from the mean. It encompasses a much larger area that's farther away from the mean, and thus the actual price distribution is a little bit flatter and the amplitude is less. Now, as you get to stock C, which has a 35 historical vol, this is the stock out of the three that is moving the most. You'll notice that its price distribution is the flattest. That is because each one of these prices on this axis here is actually getting more and more and more likely, and thus has an equal likelihood as historical vol approaches infinity. This would start to look like a flat line. As those vol levels increase, each one of these price distributions starts to get flatter. And as vol tends towards infinity, you end up with a price distribution that essentially looks like a straight line. Each price along the axis becomes equally as likely, and thus the distribution looks more flat. In 2008, when I said before, when I looked at the tape at the end of the year and 3.7 billion contracts had hit the tape, it was the craziest year I had ever seen. And when I walked into the pit every morning, someone could come up to me and say, we're going to close down 6 standard deviations today. And I would have said, okay, sure. That's equally as likely as up 6 standard deviations or unchanged. And the reason why is because the actual delivered or the historical vol of that product was really, really high. It was moving all over the place. And so thus its actual price distribution was very, very flat because each one of these price iterations along this axis basically was equally as likely. When I walked into the pit every morning, I had no idea where we were going to end up. So this really introduces the concept of implied volatility and how it affects option prices. Let's take a look at that. Implied volatility is really the knob for market makers that they can switch and change, broadly speaking, an option valuation very quickly. It is the volatility level that influences an option price the most. It can be determined via option pricing models or calculators. You can actually back out an implied volatility level from prices and prices of options where they're trading. What implied volatility really reflects is the underlying stock's expected volatility going forward by the marketplace. It's forward-looking. It is a consensus of all market participants because implied volatility levels are created by option prices. As option prices start printing, if option prices are printing higher and higher and higher and higher and nothing else is moving, the actual implied volatility level is moving. It's going up. Who ultimately determines all of these option market prices? Everyone who's in there trading, making a bid or an ask price or trading an option. It's all professionals. It's individuals. It's any time that you trade an option for a certain price, you are actually creating an implied volatility level, whether or not you know it. Now, let's look at how implied volatility levels can really affect option prices, both in a theoretical sense, and then we'll talk about an example that has a little more real-world flavor to it. First, the theoretical side of things. A change in an underlying stock's historical volatility may or may not affect its options market prices. However, if you keep everything constant and you move implied volatility, you are going to see the following. As implied volatility goes up, both call and put prices are going up. Now pay close attention to what I said there. If you keep everything constant, except implied vol, and you move implied vol, if you move it up, both call and put prices are going up. Now, conversely, If you keep everything else constant and you move volatility down, both call and put prices are going to decrease as well. Let's look at a real world example, or a little bit more of a real world example of how implied vol and Vega work in concert with each other. I'll set the stage for you a little bit. Pre-earnings, we're trading a stock that has $100 as its price. We have 13 days to expiration, and the implied volatility level is 50%. This is very important. Pay attention to that. The 105 call, it's slightly out of the money. It's worth $1.85. It has a 30 delta. These are all your Greeks associated with it. It's got a 30 delta. It has 5 cents of gamma, 15 cents of theta, 10 cents of Vega, and a penny of rho. Now let's look at what this call might do when we monkey around with all of these things, and maybe after earnings, the stock is up a significant amount. It's up $5 post earnings. Now, let's set the stage here. Days to expiration. We had 13 days. This is a week later. We only have 6 days left, but pay close attention to what's happening here. The stock is up $5. If I were to tell you, without looking at these implied volatility levels, that the 105 call was trading 185 and it had a 30 delta, and the stock was up $5, the first thing that most people would think, especially if you were here last week, is you'd do the math. You'd say 5 times 30. It should move 30 cents for every dollar it moves. It's moving up $5. I'm going to add $1.50 to this call value, theoretically, just from its delta. Well, you would be right in that situation, except for the fact that we've got some other things going on here. Implied vol has moved significantly, and our days to expiration have moved significantly. We're 7 days later. Let's take a look at what this 105 call might actually look like. With the stock trading 105 7 days later, the value of the call is 120. Now, a lot of people are going to say, why on earth would this call go down in value? Everything that you look at on this page is pointing to the stock, with the exception of removal of days to expiration, right, is pointing to the stock moving up and the value of calls going up. And if you were to say that, I would agree with you. And then I would point to this right here. The implied vol level pre-earnings was 50%, and post-earnings, it was 30%. As the stock went up in this case, even with a $5 increase in the share price, these calls lost value due to two things. Time decay, as I said, we had 13 days to expiration, now we have 6. 7 days came out. Theta was 15 cents before, so 7 days of theta are coming out. And what else do we have? Decreasing implied volatility. 50% down to 30%. We've moved vol by 20 full vol points, and Vega was 10 cents in this case. So you've got $2 worth of value that's theoretically coming out plus theta. And what you have going in is you've got a stock that's up $5 that should be adding delta value. The gamma is going to move the actual value of this option up by its delta, each dollar that's going up. And so what you see here is these competing factors as far as this option is concerned. But the point really to drive home here is that implied volatility is probably the biggest factor at work here, as far as the call being worth $1.85 pre-earnings and $1.20 post-earnings. Let's take a look at some questions as far as implied vol is concerned and Vega, and see if we can figure out where we are as far as our knowledge is concerned. With a $100 strike call, is the Vega greater on a contract expiring in 5 days, 30 days, or 90 days? Answer is 90 days. As you add time to options, you also add Vega to options. Options with longer duration have greater concentrations of Vega. Let's take a look at the next question. An investor puts on a covered call strategy. If you don't know what a covered call strategy is, when you're long the actual underlying stock and you sell calls against it, do they have a long or short Vega position? And will an increase in Vega likely help or hurt this position? Remember what I said at the beginning. If all you do is sell options, you are going to be what? You're going to be short Vega. If all you do is buy options, you're going to be long Vega. So in this case, if you're doing covered calls against long stock, you're going to be short Vega. So the position is short Vega. And if implied vol goes up, an increase is going to hurt this position. If the stock drops 15% as a result of unexpected company news, are the long or short Vega positions likely to be positively impacted? Generally speaking, when stocks go down 15% and it's an unexpected event, you're going to be increasing the general feeling of uneasiness around the marketplace, and thus probably implied vol levels are going to be going up, and thus long positions are probably going to be positively impacted by those situations. 3 things I want you to take away here. Options with longer duration have greater amounts of Vega in them. Shorter duration options have less amounts of Vega. When you sell options, generally speaking, you're going to be short some amount of Vega. If you buy options, you are generally going to be long some amount of Vega. That's because Vega is expressed as a positive number. Remember what we talked about at the beginning. Vega is expressed as a positive number. So if all you do is sell options, you're going to be short Vega. If all you do is buy options, you're going to be long. An implied volatility, as it moves, is going to theoretically move an options valuation by its Vega amount. Okay, those are the 3 things I want you to remember about implied vol and Vega. Now let's move on to the second Greek we're going to talk about today, rho. Rho and interest rates. The definition of rho. It is an option value's sensitivity to an interest rate move. It's the expected change in the value of the option with a 1% change in the risk-free interest rate. It again is expressed as a decimal form. In this case, we would say something that has 8 cents of rho. It represents a cash amount per option, just like many other of the Greeks do. All other factors of pricing remaining constant. It is generally considered one of the less significant pricing factors, primarily because, like I said at the beginning, we have been through a 15-year period where rates have been very close to zero. We're obviously starting to move rates a lot more, and so people are starting to pay a lot more attention to rho generally. But people talk about rho as like a cost of carry. So rho is, again, just like Vega, more concentrated in the longer term options than in the shorter term options. Now, it's a little bit different as far as rho is concerned, the reason why that is, but we will talk about why in just a moment. Generally speaking, people think about rho as a small part of an option's total premium. It's not really, if you were to ask me whether or not professional option traders think about implied vol or rho or Vega or rho more as far as a headline risk, I'm going to tell you that Vega is probably more of a headline risk than rho, unless you're trading options that have a significant concentration of rho in them. That is potentially true, and we'll talk about that in a moment. Here are some characteristics of rho. Generally speaking, it is generated by your pricing model, much like all of the other Greeks. Calls have positive rho, and puts have negative rho. In the old school way that people taught trading and handed down that knowledge from generation to generation, people would tell me the carry is in the call and the premium is in the put. That's how I was taught how to think about this. Calls have positive rho or positive carry, and puts have premium. Now, that's not how I teach it, but that's how people used to talk about it. The carry's in the call, the premium's in the put. That's how my options teacher taught me how to think about it, and that's how I still think about it, but I don't always teach it that way. Now, rho is largest for the in-the-money calls and puts. It decreases as options move out of the money. and rho increases with higher priced underlying stocks. This speaks to the idea of the fact that rho is largest when you're talking about big options. The reason I like to talk about it in these terms is because I think about option trading when you're talking about big options versus little options, as far as if I trade a $250 option way back in the back of the curve, I'm tying up that amount of premium for every one lot of those options that I trade for the duration of that option's lifetime or until I trade out of it. Because of that fact, if I'm tying up $250,000 in an option's value, I'm basically taking that premium. And because of the way options work, when I buy it, my account gets automatically debited that amount of money. And it's as if I'm taking that big block of money and I'm putting it somewhere else. And so rho is largest for those in the money calls that are big options, because as you buy and sell those options, you're moving big blocks of cash around, essentially. That's how I like to talk about it as far as that's concerned. It increases with more time until expiration because of the fact that those options get bigger and thus they become more sensitive to rho and they have more rho in them. Shorter term options, it has very little impact on their valuation. Leaps, you're going to see options that have a lot of rho in them. As rates increase, calls will go up because they have positive rho, and puts will go down because they have negative rho. I'm going to say that again. Generally speaking, as interest rates increase, calls are going to go up and puts are going to go down. That is a function of their rho. And conversely, as rates decrease, calls are going to go down and puts are going to go up. Also a function of their rho. Let's dive into the second order Greeks. Very briefly here, we're going to talk about charm and vama. I love to say vama. Second order Greeks, charm and its definition. This is an interesting one. Charm is an option delta sensitivity to the passage of time. It is delta decay. What does that mean? Well, much like theta is an option's value decay over time, charm is the expected change in the option delta with the passage of one day. Again, it is expressed as a decimal form. So in this case, you would say it has 0.10 or 10 cents of charm in it. The values of charm for options can be up to positive 100 and negative 100. An option that has a charm of positive 100 means that over the course of 24 hours, that option's delta theoretically should go from 0 to 100. An option's charm is dependent on whether or not it's in the money or out of the money. I want you to think about that for a moment. If you have a deep in the money call, do you think that the charm of that option is going to be positive or negative? If that option gets longer delta over time, the charm is going to be positive. And if it gets shorter delta over time, the charm is going to be negative. Thus, in the money calls and out of the money puts have positive charm values. That means that these options in the money calls get longer delta as a function of their charm over time. Also, puts have positive charm values. They get longer delta over time also. However, puts have negative delta. So you have to think about it in terms of calls have positive delta, puts have negative delta, but both of these options are becoming longer delta because of their positive charm values. Thus, calls are going to get longer and puts are going to get less short delta, but still longer, right? They're getting longer delta. They're just getting less short delta over time. This is a little bit of a kind of a mind-bending part of how charm works as far as how people talk about it. Conversely, in the money puts and out of the money calls have negative charm values. Think about it this way. This is the easiest way to think about charm in terms of out of the money calls. If you have sold an out of the money call and you've bought stock against it, like we talked about before, it's a covered call strategy. As that call decays and its value decays, so too does its delta. That is its charm at work on the delta of that option. However, does the stock that you have against that go away? The answer is no. So if you were to look at a delta neutral position that had long stock and short calls against it, and fast forwarded day after day after day after day, that position would get longer resultant delta because of the fact that the calls that are providing short delta against the long delta from the stock are starting to decay. Their power over that position is beginning to erode because their actual valuation is eroding. That's their charm. The charm is pulling delta out of that option. The delta of the stock doesn't change. And so that position, as you are a covered call writer, is theoretically getting longer delta on a daily basis. And thus, it's getting more sensitive to the underlying price movement because the delta from the stock doesn't go anywhere, but the delta from the calls starts to dissipate over time because of its charm. The next one we're going to talk about is VAMA. I love to say VAMA. VAMA's definition is an option Vega's sensitivity with respect to implied volatility levels. Notice, this doesn't talk about the option's valuation. It talks about the option's Vega. Much like charm doesn't talk about valuation, it talks about the option's delta. This is a second derivative that talks about option Vega's sensitivity with respect to implied volatility levels. What this means is that options that are priced at different implied volatility levels have different amounts of Vega in them. VAMA is your expected change in option Vega with a 1% change in the implied volatility. Much like Vega is the expected change in the value of the option when you move vol by 1%, VAMA is the second derivative of that. It's not only talking about how much the option should move in value, that's its Vega, it's saying how much should the Vega move when you move the implied volatility. And so because of this fact, because of the fact that it's its second derivative, it actually adds what we call curvature. It's expressed as a decimal form. It's also expressed as a positive number, much like gamma is. Remember, gamma is potential change. VAMA is the same thing. It's potential change of the Vega of an option. But many people refer to it as Vega convexity because of the fact that it is that second derivative, much like gamma changes a delta of an option over a move and thus gives it actual curvature to its delta, curvature to its value. VAMA does the same thing for Vega. It is convexity. It is curvature of the Vega that is in an option. It adds curvature to that relationship between implied vol and its options price. And so it has natural convexity. It can be helpful in estimating big moves of implied volatility. The reason why is because if you're moving an option's implied vol from 20 up to 25, which is only 5 points of actual implied volatility, that's not really going to move the Vega of the option that much. The VAMA is not really going to kick in quite as much unless you were doing something like moving it from 20 up to 100. If you were doing something like moving it from 20 up to 100, the actual curvature of the convexity is going to really kick in and start to give you a better idea of how much Vega is going to be in that option with the implied vol at 100 versus the implied vol at 20. And the difference there is going to be your VAMA. VAMA is something that people use when they're trying to model huge moves in implied volatility. Because if you have large swaths of options on in an options portfolio, and you want to think about what my portfolio might look like if vol quadruples, VAMA is a perfect way to actually take a look at that, because what it does is it adds curvature to that, and it gives you an expected change in the Vega of the option as you really move those implied vols significantly to the upside or to the downside. So that's where people use those second derivative options. Remember, charm is an options delta decay, and VAMA is the actual convexity of its Vega. It's the curvature of the Vega of the option as you move implied volatility levels. So I hope that you guys didn't get too derailed by those second order Greeks. I know they can be kind of mind bending sometimes, but let me take a look at some of the questions that we might have coming in. Let's see, Q&A. Oh, maybe there aren't any questions. Ken, are there any questions on there?
Hey, Matt, can you hear me?
Yeah, I can hear you.
So, yeah, all the questions, you just have to hit the trash icon because we moved them there to clean up the inbox. So if you hit the trash, you'll see all the questions and the answers. But
I see it.
You know?
I see it. So here's a good question. How about a 3 to a 7 day option on an earnings announcement placed just before the earnings announcement? I assume this question is talking about, so that the example that we gave earlier was an option that had 13 days in it, and then an option that had 7 days in it. So you would, or like 6 days in it. So 7 days had come out and the options were happening, and and the earnings were happening. You would see most likely, if we're talking about 3 to 7 days of days to expiration on that option, you would see those same kinds of effects, but they would be even more protracted. You would see the actual value of the option moving by even more because of the fact that as you get closer to expiration, all of those Greeks start to get kind of supercharged in nature. So gamma becomes exponential, theta increases as we get closer to expiration. All of those things are a function of time. And if you think about time as far as expiration is concerned, I like to talk about it in this way. If we have 100 days left in an option and we remove 1 day out of that price iteration, let's say we actually fast forward our clock 24 hours and we move 1 day of price iteration out of that option, we're moving 1 out of 100 days out of it. That's not very much. It's obviously 1% of its lifetime. If you have an option that has 5 days in it and you fast forward your clock 24 hours and you move 1 day out of it, well, that option only has 5 price iterations or 5 price settles left in it. And so you're removing 1 of those days, you're removing 20% of that option's lifetime as far as the actual time is concerned. And thus, you should expect to see a commensurate amount of Greeks associated with that coming out of the option in terms of Vega, in terms of theta. You should also expect to see the gamma go exponentially higher as you start to remove 1 out of the 5 days, 2 out of the 5 days, 3 out of the 5 days of that option, because that option is becoming more and more and more sensitive to the actual movement of the underlying. Thus, its delta is going to tend more towards 100 or 0, and thus its gamma is going to become exponential as you get closer and closer to expiration. Let's also talk about, let's see. Can we get a recording of the first session? You can get a recording of the first session. Make sure you go to optionseducation.org, this website right here. You can download all of the podcasts and videos that we have there and set up an OCC learning account. This is a fantastic way for people to really have a self-guided experience through all of the educational material that we have posted on the site. It's a great way for you to engage in that educational material, and it gives you a way to be able to view all of that stuff on demand and free of charge. Again, remember, everything that we do, all of these things that we produce, we do free of charge because we are fully funded by our parent corporation, the Options Clearing Corporation. Let's see. Charm, is it the same thing as gamma? Well, I hope if you listened through the entire thing that you would be able to answer that question for me. It is not the same thing as gamma. Charm is actually the delta decay of an option. Remember that. Charm is the delta decay of an option. It's thinking about it in terms of like theta, but for the delta of an option. Whereas theta speaks to the value of the option on a daily basis, how much the option should decay on a daily basis and its value. Charm speaks to the decay of the delta on a daily basis. A couple of other questions on here. Does OIC provide implied volatility or historical volatility data? If not, what is a possible site for this data? We do not provide historical volatility or implied volatility data for the options that are in the marketplace currently, but what we do have is a really fantastic tool called the Options Calculator that you can find again at optionseducation.org. That tool is something where you can actually go through and it's kind of infinitely customizable. It'll allow you to change all of the different inputs into the model as far as days to expiration, interest rate, strike of the option, underlying price, etc. And it'll actually allow you to move those things around, and then you hit calculate and it spits out the actual value of an option, the calls and the puts, and it'll give you all of the resultant Greeks from a theoretical perspective with using those inputs that you input on the left-hand side of the options calculator. Make sure you check that out at optionseducation.org. Let's see. Where can I find a replay of this event? I missed the first 30 minutes. That is okay. Again, if you go to optionseducation.org, I would guess that this webinar will be up there probably sometime tomorrow or the next day. But if you didn't watch the first one from last week, you should go through and watch the Greeks 1, which includes delta, gamma, and theta, the first of those three Greeks that we talked about, and give it a day and wait for the Greeks 2, this one that we did today, to come back up, and then you'll be able to check that one out as well. So I hope that everyone found this really useful, and if you have questions, please remember to check out optionseducation.org, the website where we host all of our educational content, and also send us emails at options@theocc.com. Again, the 4 of us that work there have 100 years of options trading experience, either on the trading side or the brokerage side. We love to answer questions about how options work. The other thing I want to make sure everyone knows is on the 12th and the 19th of next month, my colleague Roma is going to be doing both of the OIC webinars for next month. So make sure you check those out, the 12th and the 19th. I believe the topics are going to be income generating, covered call strategies, and the poor man's covered call. They're going to be fantastic. So make sure you come back and register for those at optionseducation.org as well. Thanks a lot for your time. I really appreciate it. And I hope you guys learned something today. Have a great day.